Welcome to Iron Financial, the place where we help you forge a stronger portfolio and cut right through all the market weakness. All right, let's get right into it. BlackBerry is on deck to report earnings, and you can feel it. The market is absolutely holding its breath. The stakes right now are higher than they've been in years. The conversation is no longer about survival. It's about pure, unadulterated strength. We are way past the point of wondering if they can keep the lights on. The real question now is, can they actually build a skyscraper on the foundation they've spent all this time laying?
Right, that's the perfect way to put it. Because, we've been hearing this turnaround story for what feels like an eternity. They've cut the costs, they've made the pivot away from phones, they're finally posting these non-GAAP profits. That's the whole narrative they're selling, but is that foundation really solid? Is it built on granite or is it built on sand? Or are we just looking at a company that's learned how to tread water really, really well, making the balance sheet look pretty while the actual core business is just stagnant? That is exactly what we are here to find out. We are going to stress test this entire structure and see if it holds up under pressure. Exactly. Look, the pivot from phones to software is complete. That chapter is closed, it's done, it's in the history books. They are, for all intents and purposes, an established player now in two absolutely critical, high-stakes fields: the Internet of Things, or IoT, and cybersecurity. So that foundation, it's set. But, and this is the big but, the market has one critical, absolutely non-negotiable demand. Prove you can build on it. Prove you can grow the top line. Enough with the fancy accounting. Show us more sales. So let's start the inspection. Let's dive into the numbers and see what they're really made of. Okay, first things first. Let's look at the baseline expectations for the fourth quarter of their fiscal year 2026. This is the immediate scorecard. You can think of this as the initial walkthrough with the building inspector. Does the work that's been done meet the absolute basic code? This is the bare minimum requirement before we can even begin to have a serious conversation about real long-term strength. So BlackBerry's own guidance, what they told the market to expect for Q4 revenue, is a range. It's between $138 and $148 million. This is the company putting their own reputation on the line, telling everyone, this is what we believe we can deliver. It is their own blueprint for the quarter, and you better believe any deviation from this, high or low, is going to be heavily, heavily scrutinized.
Now, Wall Street, as it usually does, has taken that range and planted its flag right in the middle. The consensus estimate from the analysts who cover the stock is $144 million. So you need to understand, hitting this number, 144, that's just meeting expectations. It doesn't win you any awards, it doesn't get you a bonus, it just means you did the job you were supposed to do. It's the bare minimum.
And then we look at the bottom line, earnings per share. The street is looking for 4 cents. This number falls comfortably inside the company's own guided range of 3 to 5 cents per share. So when you look at both revenue and earnings, the targets are crystal clear, they're well-defined. There really shouldn't be any major surprises here, at least on the surface. Right, but let's put this into perspective, because numbers on a page can be deceiving. You can see it clear as day on the chart right there. The bar for this year is barely, and I mean barely, taller than the bar for last year. So if they hit that $144 million mark, we're talking about a minuscule, almost meaningless beat year over year. Like you said, this isn't a skyscraper. This looks like a prefab single-story building they just dropped on the lot. The revenue has completely flatlined. A couple of percentage points of growth? Come on, that's not strength. It might be stability, sure, I'll give you that, but it is not inspiring anyone to write a big check. Precisely. A beat here, it's not the heavy lifting. Hitting these Q4 numbers is just table stakes to even be in the game. The crucial point, and this is what we're going to break down right now, is what's happening under the hood. You cannot judge the health of a building just by looking at a shiny facade. You have to get in there and inspect the internal structure, the plumbing, the electrical. And for BlackBerry, this company is a tale of two completely different divisions. One is holding the entire structure up, and the other, well, it's starting to show some serious signs of wear and tear. So on one side, you have this gleaming high-tech pillar, QNX. This is their Internet of Things division. This is the real growth engine. It's the software that's embedded in everything from cars, and I mean millions of cars, to critical medical devices. For the quarter, it's expected to post revenue between $71 and $77 million, and that, my friends, represents solid, undeniable growth. This is the main load-bearing wall of the entire company right now.
Okay, I will absolutely grant you that. That part of the structure looks solid, it looks sound, you've got year-over-year growth, you've got sequential growth from last quarter, and that $865 million backlog, that's a seriously solid pipeline of future revenue. It's almost guaranteed money. So yes, I agree, the QNX pillar is made of solid steel. But here's the problem. A skyscraper can't stand on a single pillar. What in the world is holding up the other side of the building?
And that's where we see the cracks.
The Secure Communications Division, their cybersecurity arm, is expected to bring in somewhere between 61 and 65 million. Now that is a potential decline from the 67.3 million they did in the exact same quarter last year, and it's a drop from the 67 million they just did last quarter. So this pillar isn't just not growing, it appears to be actively shrinking. It's stagnant. It is a dead weight on the entire structure, and its poor performance is dragging down all the impressive growth that we're seeing from QNX. So you have a growth engine and a stagnant pillar. That sounds like a dangerously unbalanced structure. And yet, the big headline for the full year is that they are profitable. And not just a little profitable, substantially profitable. How in the world does that math work? If one half of your business is shrinking, how is the bottom line all of a sudden looking so strong? To me, that smells a lot like financial engineering, not fundamental business strength. That's it. That is the central puzzle that serious investors are trying to solve right now. The turnaround in profitability, just on paper, has been absolutely massive. And if you're just glancing at the headlines, it looks incredibly impressive. But we have to dig deeper. We have to ask the hard questions. Is this a real sign of a healthy, thriving business? Or is it a mirage created by some clever accounting? Let's really put this in perspective so you can see what we're talking about. Okay, look at this. In fiscal year 2025, BlackBerry posted a net loss of roughly $79 million. $79 million in the red. This year, fiscal 2026, they are guiding to be profitable in the range of $43 to $48 million. $43 to $48 million in the black. That is a swing of over $120 million to the positive in a single year. This is a truly monumental shift, and this chart right here, it brilliantly illustrates the core of the entire bull versus bear debate.
Whoa, hold on. This is exactly what I was just talking about. Is this profit built on a real, solid foundation of growing revenue, or is it a house of cards that's been built on nothing but aggressive, painful cost-cutting? The analyst in our source material absolutely nails it here. The question is, are they actually building a stronger business that sells more stuff to more people, or are they just firing people and closing offices to make the same old flatline business look better on a spreadsheet? That is not strength. That is a short-term fix, and it's not sustainable.
And that is the bear case in a nutshell. Real, durable, long-lasting corporate strength comes from top-line growth. It comes from selling more products and services, not just from reducing your headcount or shrinking your office space. And that, right there, is why this upcoming earnings report isn't really about the quarter that just ended. It's about the future. And it all comes down to one single, all-important, make-or-break number. Let's move on to the main event. Honestly, forget the Q4 numbers for a moment. They're already in the rearview mirror. The single most important piece of data that will come out of this entire report will be the full-year revenue guidance for fiscal year 2027. This is it. This is the number that will tell us whether this foundation is strong enough to actually build on, or if this is as good as it's ever going to get. This slide right here illustrates the entire battlefield. This year's total revenue will probably land somewhere around $536 million. That's our starting point, our baseline. Now, Wall Street, they need to see a guide of at least $577 million for next year just to be satisfied. And that only represents kind of modest, low single-digit growth. But for the stock to truly show strength, to really move the needle and prove the bull case is real, BlackBerry absolutely needs to guide for $650 to $700 million. That would be a statement. That would be proof of life. That would be real, tangible growth.
So, what you're saying is, even if Q4 is a complete blowout, even if they come in and smash the $148 million high end of their own guidance, a soft, weak guide for next year means the market will immediately see it as a trap. A weak outlook suggests that management has zero visibility into future growth. It suggests the sales pipeline is weak and that the underlying structure simply cannot support any significant expansion. It tells the entire market that the flat line is here to stay.
Exactly. This is the moment of truth. This is where the company proves once and for all if they're building up or just holding on. Are they the scrappy survivor that everyone feels a little sorry for, or are they a reborn, powerful growth company? The fiscal year 2027 guidance, that is the entire story, full stop. So, with all that said, let's forge all of this information into a final verdict. Okay, so when the numbers come out, here is the official Iron Financial Scorecard. This is the framework you should use to instantly analyze the report and cut through the noise. Here is what separates a strong report, a real opportunity, from a weak one, which is nothing but a trap for unsuspecting investors. Here is what a truly strong, a truly bullish report looks like. You can just check these boxes. 1, they don't just meet, they crush the high end of their Q4 guidance, coming in well above $148 million.
2, and this is the big one, they issue a confident, strong forecast for fiscal year 2027, guiding for revenue over $650 million. 3, the QNX engine is firing on all cylinders, and that all-important backlog is marching steadily towards $1 billion. 4, the secure communications business finally stops the bleeding. It stabilizes, and in a best-case scenario, it shows some surprising signs of life. And finally, number 5, the profitability outlook is clearly tied to that new revenue, not just old cost-cutting. That is the blueprint for a solid, expanding structure.
And the trap, the weak report that we're worried about, is simply more of the same old story. It's a Q4 beat, maybe, but it's paired with that flat, uninspiring guidance around that $577 million mark for next year. It would show continued stalling revenue and further decay in that cybersecurity business. That kind of report tells investors that the foundation is stable, yes, it's not going to collapse. But that's all it is. It means there are no plans for a second story. It is a finished project, and it is most definitely not a growth story. So, the crucial point for everyone to take away is this. BlackBerry has done the hard, painful work to ensure its survival. There's no doubt about that. They tore the old structure down to the studs, and they rebuilt a stable, profitable software company. But this report, and specifically that one guidance number for fiscal year 2027, will tell us if they have what it takes to truly, finally thrive, to build something for the future. Survival is done. The test of strength begins now. We will be watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.